Market tops, like the great turning points in history, do not arrive as a single sudden event. They are a process. They are a slow, often deceptive, and highly psychological transition of power from the hands of the buyers to the hands of the sellers. The public, captivated by the euphoria of a long advance, typically only recognizes a top long after it has passed, when the subsequent decline is well underway. But for Richard Wyckoff, identifying a major market turn was not a matter of hindsight. He viewed it as a case to be solved, a logical sequence of events that could be observed, analyzed, and acted upon. He developed a step-by-step process for this work, a method for the analyst to act as a detective, gathering a chain of evidence that points to the inescapable conclusion that the smart money is completing its campaign and that a reversal is imminent. This video is a guide to that process. We will begin by dissecting the anatomy of a market top, walking through Wyckoff's four-step procedure for identifying the subtle but definitive signs of distribution. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The first step in timing a market turn is to recognize the change of character. An established uptrend has a distinct personality. It is characterized by a series of higher highs and higher lows, with advances occurring on expanding volume and reactions occurring on contracting volume. The very first sign that a major reversal may be approaching is a distinct and often dramatic shift in this established behavior. Wyckoff identified two key events that signal this change of character. The first is preliminary supply. After a long and often steep advance, a point will be reached where a rally is halted on a sudden and conspicuous increase in volume. This is the first time in the entire uptrend that a wave of aggressive demand is met by an even more powerful wave of supply. While the price may not decline significantly at first, this event serves as an initial warning. It is the first footprint of the composite man beginning to sell or distribute his shares. This is often followed by the main event, the buying climax. A buying climax is the culmination of the public's speculative frenzy. Driven by greed and the fear of missing out, the public rushes into the market in a final climactic wave of buying. The price surges upward, often in an almost vertical fashion, on the highest volume seen in the entire uptrend. To the amateur, this looks like the moment of greatest strength, a final confirmation of the bull market. To the Wyckoff analyst, it is the most dangerous of all signals. He applies the law of effort versus result and sees a fatal divergence. The immense effort, which is the climactic volume, fails to produce a corresponding result, which would be a sustained hold at the new high prices. Instead, the price often stalls and closes well off its peak for the day. This is the irrefutable evidence that the composite man is meeting the public's frenzied buying with a massive, overwhelming wave of selling. He is using the public's euphoria as the perfect opportunity to unload a huge portion of his holdings. The buying climax marks the exhaustion of the market's buying power and signals that the uptrend has, at the very least, been critically wounded. Once the buying has climaxed, the second step in the process begins, defining the battlefield. The sudden influx of heavy supply from the buying climax causes the first significant decline, an event Wyckoff termed the automatic reaction. This sharp drop is a direct consequence of the buying power being overwhelmed. The low point of this automatic reaction is critical, as it establishes the lower boundary, or the support line, of the new distribution trading range. The high of the buying climax establishes the upper boundary, or the resistance line. The market, which was previously in a clear uptrend, has now entered a sideways phase. The battle between the remaining buyers and the powerful sellers will now be fought within the confines of this range. The next key event is the secondary test. After the automatic reaction, the stock will attempt to rally back toward the high of the buying climax. The character of this rally is a crucial piece of evidence. In a classic distribution top, this secondary test will occur on a volume that is noticeably diminishing. The price may approach the old high, but the volume is a fraction of what it was during the climax. This is a clear and powerful sign of weakness. It proves that the buying demand has been exhausted. The powerful effort that created the buying climax is no longer present. A failure of the price to even reach the old high on this test, creating a lower top, is an even more potent sign that the sellers are now in control. The trading range has been defined, and the initial tests have confirmed the presence of significant supply and the waning of demand. The third step in the process is the longest and most patient, weighing the evidence within the trading range. The composite man cannot unload his entire massive line of stock in a single day. The process of distribution can take weeks or even months of sideways churning action. It is during this period that the Wyckoff analyst gathers the final, conclusive evidence that a major top is being formed. He is looking for repeated signs of weakness. These are sharp, downward price swings within the trading range that occur on a sudden expansion of volume. This shows that the supply side is becoming more aggressive, pressing its sales onto the market on any signs of weakness. Conversely, the rallies within the range will be labored and feeble. A rally may occur on high volume, but it will struggle to make any significant upward progress, stalling out well below the resistance line. This is a classic example of the law of effort versus result showing disharmony. The great effort of the buyers is failing to produce a result, proving that the overhead supply is too great to overcome. At other times, rallies will occur on conspicuously light, fading volume, showing a clear lack of demand and professional sponsorship. As this process continues, the chart will often begin to trace out a series of lower tops within the range, as sellers become more eager and are willing to accept lower and lower prices to complete their distribution. After the composite man has methodically fed his stock into the market, and the buying power of the public is largely exhausted, he may engage in one final deceptive maneuver. This is the fourth and final step in identifying the turn, identifying the final deception, or the upthrust after distribution. The upthrust is a manipulative price move that pushes the stock to a new high, just above the resistance line of the trading range. Its purpose is to trap the last of the bulls and to catch the stops of any bearish traders who have already established short positions. It is designed to look like a genuine breakout, a resumption of the old uptrend. The Wyckoff analyst, however, is not fooled. He uses his understanding of volume to verify the move. An upthrust is typically characterized by a price breakout on conspicuously low volume, which indicates a complete lack of genuine demand, or by a breakout on a climactic burst of volume where the price immediately stalls and makes no further progress, indicating that the move was met with overwhelming distribution. The ultimate confirmation of the upthrust is its swift failure. The price is unable to hold its gains and quickly falls back into the old trading range. This confirmed failure is one of the most reliable and powerful signals in the entire Wyckoff methodology. It is the final piece of evidence that the distribution is complete, the bulls have been trapped, and the path of least resistance is now definitively to the downside. The meticulous step-by-step process of weighing evidence was the hallmark of Richard Wyckoff's approach. He was one of the great market analysts of his era, who sought to find the underlying order and logical structure behind what appeared to be chaotic market movements. His contemporary, the legendary William Gann, was another master of market forecasting who developed his own unique and powerful methods, often using a combination of geometry, astronomy, and the study of time cycles to predict major market turns with incredible accuracy. For those interested in exploring these complementary yet different approaches to market analysis, you are invited to visit our new sister channel, William Gann Trading Insights, for a deep dive into his fascinating methodologies. The link to this channel is located in the description of this video. Having meticulously detailed the step-by-step process Richard Wyckoff used to identify a major market top, we now turn our attention to the opposite and often more profitable side of the cycle. Just as the end of a bull market is a logical, observable process, so too is the end of a bear market. The same principles of analysis, the same focus on the sequential accumulation of evidence, and the same understanding of the composite man's motives are applied in a mirror image to find a major market bottom. This is the process of timing the turn from despair to hope, from decline to advance. This section is a guide to that process. We will walk through Wyckoff's four-step procedure for identifying the signs of accumulation, the foundational phase that precedes every significant bull market. The first step in timing a market bottom is recognizing the climax of the decline. After a stock or the general market has been in a prolonged and often punishing downtrend, the decline will frequently accelerate as the last of the public holders finally capitulate. This phase is dominated by fear, despair, and the complete abandonment of hope. It is in this environment of maximum pessimism that the first signs of a major reversal begin to appear. The first of these signs is preliminary support. After a long downward march, a point will be reached where a day or week of trading shows a noticeable increase in volume and a widening of the price spread, and the decline is temporarily halted. This is the first footprint of the composite man, the first indication that large informed interests are beginning to step in and absorb the shares being offered. While this initial support is rarely enough to stop the decline completely, it is a crucial alert to the Wyckoff analyst that the character of the market is beginning to change. This is often followed by the main event, the selling climax. This is the culmination of the public's panic. The price plunges, often in an almost vertical fashion, on the highest volume seen in the entire downtrend. To the amateur, this looks like the moment of greatest weakness, a final, terrifying confirmation of the bear market. But the Wyckoff analyst sees it through the lens of the law of effort versus result. He understands that for every share sold in a panic, there must be a buyer. The climactic volume of a selling climax represents a massive transfer of ownership. The immense effort, represented by the huge volume of selling, fails to produce a corresponding result which would be a continued sustained collapse. Instead, the price stops going down. The key characteristic is that after plunging to its extreme low, the stock will often rally to close well off the bottom. This is the irrefutable evidence that the force of supply has been met and conquered by an even greater force of demand. It is the composite man absorbing the public's fear. The selling climax is the violent but necessary conclusion of the downtrend and the first definitive step in the process of a new bull market. Once the panic selling has been absorbed, the second step begins, defining the new zone of operations. The sudden vacuum of selling pressure that follows the selling climax leads to an almost reflexive rally. Wyckoff termed this the automatic rally. This is the first significant advance after the bottom, and its high point is critical as it establishes the upper boundary or resistance line of the new accumulation trading range. The low of the selling climax establishes the lower boundary or support line. The market has now shifted from a downtrend into a sideways phase. The subsequent battle between the remaining sellers and the powerful new buyers will now be fought within these confines. Following the automatic rally, the market will invariably drift back down to test the area of the selling climax low. This is the secondary test, and it is one of the most important events in the entire accumulation process. If the intense selling pressure that caused the climax is truly over, then this test of the low must occur on significantly diminished volume. A decline back to the support of the range on volume that is a mere fraction of what was seen during the climax is the definitive proof that the supply has been exhausted. It confirms that the panic has subsided and there are very few shares being pressed for sale at these low levels. This successful low-volume test validates the selling climax as a genuine turning point. It proves that the composite man's initial buying was not just a temporary support measure, but the beginning of a deliberate campaign. If, on the other hand, the secondary test occurs on high volume, it indicates that the liquidation was not complete and that further declines are likely. The third step in the process is the longest and requires the most patience from the analyst, weighing the evidence of absorption. Once the trading range has been defined and the secondary test has confirmed the exhaustion of selling pressure, the composite man begins his primary work of accumulating his full line of stock. This can take weeks or months of what often appears to be dull, lifeless, sideways action. During this time, the Wyckoff analyst is a detective, constantly searching for subtle clues that demand is quietly gaining control. The most important of these clues is the drying up of supply. On each subsequent dip or reaction toward the support of the trading range, the volume should become progressively lighter. A period of extreme dullness and low volume after a reaction is an exceptionally bullish sign. It shows that the stock is no longer responsive to selling pressure. There are simply very few shares left to be sold at these levels. The sellers are gone. The other key piece of evidence is the formation of higher lows. After the initial low of the selling climax and the secondary test, each subsequent reaction may stop at a slightly higher level than the one before it. This is a subtle but powerful sign of strength. It indicates that the buyers are becoming more aggressive. They are no longer waiting for the price to fall to the absolute bottom of the range to acquire shares. They are willing to raise their bids to meet the few remaining sellers. This persistent lifting of the support points, combined with the diminishing volume on those reactions, is the clearest possible evidence that the stock is being absorbed and a solid foundation is being built for a future advance. After the composite man has methodically absorbed the majority of the floating supply, he often initiates a final decisive maneuver to ensure the market is ready for the markup phase. This is the fourth step, identifying the final test, which is the spring or shakeout. This is the final bear trap, a move designed to mislead the public one last time before the true trend begins. A spring is a sharp and often brief price move that penetrates the established support level of the trading range, only to quickly reverse and climb back into the range. Its purpose is to create a final wave of fear, to trigger the stop-loss orders of any remaining weak hands, and to allow the composite man to acquire their shares at the lowest possible prices. The key to identifying a spring is its confirmation. The price must not linger below the old support line. It must swiftly recover and reclaim its position within the trading range. The volume on a spring provides additional confirmation. A spring on very low volume is a powerful sign that supply is completely exhausted. A spring on high volume, where the price stops falling and quickly reverses, is evidence of a massive absorption of the final wave of selling. A confirmed spring is one of the most reliable and powerful signals in the entire Wyckoff methodology. It is the final conclusive piece of evidence that the accumulation is complete. The supply has been removed from the market and the stock is on the springboard ready for a major advance. When the analyst has successfully followed these four steps, he has timed the turn with the logic and precision of a professional. Having meticulously followed the step-by-step process of identifying a major market top and a major market bottom, the Wyckoff analyst arrives at the final and most critical stage of the operation, confirmation and action. To recognize that an accumulation or a distribution campaign is likely complete is a monumental achievement in itself. It places the analyst far ahead of the uninformed public. But this knowledge alone is not enough. The final step is to translate this analysis into a concrete, low-risk trading campaign. This requires the patience to wait for the market's final, unambiguous confirmation of the turn, and the strategic foresight to plan the entry, the exit, and the profit objective with the precision of a business owner. This is the culmination of the detective's work, the moment where observation is translated into profitable action. The fifth step in the process is waiting for the definitive confirmation of the reversal. A Wyckoff trader never attempts to buy at the absolute bottom or sell at the absolute top. He understands that these points are scenes of intense and often chaotic battles. He prefers to wait for the smoke to clear and for one side to emerge as the clear victor. He waits for the market to prove his analysis correct before he commits his capital. For a new uptrend, the ultimate confirmation comes after the successful completion of the accumulation phase. This confirmation is a two-stage event. The first stage is the jump across the creek. This is the decisive breakout above the resistance line of the accumulation trading range. It must occur on a distinct expansion of volume, proving that demand is now powerful enough to overcome all remaining overhead supply. This is the market's signal that the period of preparation is over and the markup has begun. The second stage is the backup to the edge of the creek. This is the pullback to test the old resistance line as new support. This test must occur on a dramatic shrinkage of volume, proving that supply is exhausted. The successful completion of this test is the final, low-risk entry signal. It is the market's invitation to get on board. For a new downtrend, the process is a mirror image. The final confirmation that a distribution phase is complete comes with the fall through the ice. This is the decisive breakdown below the support line of the distribution trading range. It must be accompanied by expanding volume, proving that supply is now in aggressive control. This is often followed by a last point of supply, which is a feeble rally back to the underside of the broken support. This rally must occur on light, diminishing volume, proving that buying power is absent. This failure at the old support is the final confirmation of the new downtrend and offers a low-risk opportunity to sell short. The sixth step is a final litmus test, a method for ensuring that capital is deployed only in the most promising vehicles. This is the test of comparative strength. Wyckoff taught that in any market, there are leaders and there are laggards. At a major market bottom, the stocks that are destined to become the leaders of the new bull market will be the first to turn up, and their rallies will be stronger than the market average. They will show superior strength. Conversely, at a market top, the stocks that are the weakest will be the first to break down and will fall faster than the average. They will show superior weakness. Before entering a trade, even after a clear reversal signal, the Wyckoff analyst compares the action of his candidate stock with the action of the general market average. By choosing to buy only the strongest stocks in an upturn and to sell short only the weakest stocks in a downturn, he dramatically increases the probability that his trades will move swiftly and profitably in his favor. The seventh and final step is the culmination of all the preceding analysis: planning the campaign. A professional operator never enters a trade without a complete plan. This is the final step that transforms the analysis into a structured business proposition. First, the trader must define his entry point, which, as we have discussed, is ideally upon the confirmation of the turn. Second, he must define his risk by placing a logical initial stop-loss order. For a long position taken after a spring and a jump across the creek, the stop is placed just below the low of the spring or the low of the backup to the edge of the creek. For a short position, it is placed just above the high of the upthrust. Third, he must define his potential reward. This is done by using the point and figure chart to perform a horizontal count of the preceding accumulation or distribution range. This count provides a logical price objective for the subsequent move. If the potential reward is not at least 3 times the defined risk, the trade is not taken. This final, methodical step ensures that every commitment is a sound business venture with a high probability of success and a favorable risk-to-reward ratio. For those who wish to truly master the lessons discussed here, it is essential to study them from the source. Please take note of a unique new edition of Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, by Max Davidson. It has been meticulously adapted for the modern trader, with complete explanations that make Wyckoff's timeless wisdom more accessible than ever. For anyone who wants to truly absorb the lessons we are discussing, this adapted edition is an indispensable part of your library. The link to this book is located in the description of this video. In conclusion, timing a market turn according to the Wyckoff method is not a mystical art of prediction. It is a patient, step-by-step process of gathering and weighing evidence, much like a detective solving a complex case. Each step, from recognizing the initial change of character to the final confirmation and campaign plan, is a logical deduction based on the market's own testimony. The genius of Richard Wyckoff was in providing this coherent and repeatable process. It is a method that allows the analyst to move beyond the noise of news and opinion, to understand the true intentions of the market's largest operators, and to act with the quiet confidence of a professional who has done his homework and is ready for the opportunity the market provides.